How do startups go from an idea to raising hundreds of millions of dollars? Venture capital isn't just about getting money, it's about knowing when to raise, how much to raise, and what investors expect at each stage of the journey. From seed funding to Series C and beyond, each round comes with different challenges, dilution concerns, and strategic implications. Raise too early and you give up too much equity. Raise too late and you might run out of cash. Today I'm breaking down the differences between seed stage investment, Series A investment, Series B investment, Series C investment, how valuation shifts across rounds, the biggest mistakes founders make when fundraising, and how to protect your equity while scaling. Let's dive in. Hey everyone, I'm Corey, a startup lawyer helping entrepreneurs decode law, technology, and innovation. Today we're breaking down the venture capital funding life cycle, what each round means, how investors think, and how founders can strategically raise money while keeping control of their company. If you're a startup founder thinking about raising money, this video is definitely worth your time, so let's get straight into it. Here's what we'll cover in this video. Early stage versus later stage funding, how startups move from seed stage to Series C, how valuations shift between rounds, investor expectations at each stage, the biggest mistakes founders make when raising venture capital, and how to protect your ownership from dilution. All right, now let's break all this down. So first, early stage versus later stage funding. VC funding is split into two different phases. Early stage, Series Seed and Series A, it focuses on proving the business model. Later stage, Series B and C+, etc., focuses on scaling operations and dominating the market. Each stage has different investor expectations, and if you're a founder, you need to know where you stand before you're pitching your investors. Seed funding, proving the concept. What is it? The first major funding round where startups raise capital to develop their product, build an MVP, and gain early customers. Typically, the investment size can range anywhere from $500,000 to $5 million. So who are the key investors? Angel investors, early stage venture capitalists, as well as funds that focus on pre-seed investment. The investor focus is on market potential, early traction, and a strong founding team. At this stage, investors are betting on the team more than the numbers. So next, Series A, building a scalable business model. What is it? So Series A funding is when startups transition from an MVP to a revenue-generating business. Investors at this stage expect a clear go-to-market strategy and evidence of demand. The investment size tends to be anywhere from $5 million all the way up to $20 million. The key investors at this stage tend to be institutional venture capitalists, as well as corporate investors, or CVCs, standing for corporate venture capitalists. The investor focus tends to be revenue traction, user acquisition strategy, and market fit. Founders must demonstrate a repeatable, scalable revenue model at this stage. Next, we have Series B, scaling operations. Series B is all about accelerating growth and optimizing operations for efficiency. Startups use this funding to expand into new markets, hire aggressively, and solidify their customer base. The investment size at this range can vary drastically, anywhere from $20 million up to $100 million or larger. Key investors tend to be growth stage venture capitalists, and the investor focus tends to be on unit economics, customer retention, hiring, and team expansion. Startups need to show they can scale both profitably and efficiently at this level. So next we have Series C, which is focusing on market domination and expansion. Series C is focused on market leadership, acquisitions, and preparing for an IPO or major exit. At this point, startups often acquire competitors, expand globally, or invest heavily in R&D. The investment size here can be anything from $50 million and up. There's really no ceiling. Key investors tend to be late-stage venture capitalists, and sometimes you do get private equity investment here, and sometimes, in a relatively less common case, you may even get hedge fund investment. The investor focus at this stage is profitability, exit potential, and competitive advantage. And at this stage, startups are basically on the path to IPO or acquisition. So let's recap. Seed stage, prove the concept, secure early adopters. Series A, build a scalable business model. Series B, optimize operations and expand. Series C and beyond, achieve market dominance and prepare for an exit. As you'll note, fundraising isn't just about money. It's about bringing the right investors at the right time. As I've alluded to in other videos, make sure you check out the videos where we go over safe notes and convertible debt and other parts of the VC fundraising process. So stay tuned. Join me on the path to decoding law, technology, and innovation to grow your business. And don't forget to like, share, subscribe, and hit that notification bell. Until next time.